Hello, everyone, and welcome back to another MRMIA broadcast. I'm your host, Marc Leprince, and you guys are listening to the Model Risk Managers International Association. We're continuing our credit scoring series today with Raymond and Pravin, and this is where we're going to discuss a range of topics surrounding model risk during shock periods, benchmarking, and overlays, all as it relates to credit risk models. So to introduce our guest today, we have Raymond Anderson, who joined us last time, a published author on credit intelligence and scoring with over 25 years of practical experience. We also have joining us again, Pravin Burra, CEO of Analytix Engine, a boutique modeling and credit modeling and machine learning modeling consultancy with over 20 years of experience. He has experience in credit modeling, model risk management, and was a previous partner at Deloitte, South Africa. And today's topic is actually going to focus on preparing for shock. So in our last talk, we covered the reasons why shocks can occur. And we now know that those can be caused by a variety of factors, including economic crisis, trade disputes, natural disasters, and of course, pandemics. And from our last talk, we also learned that they can affect the clients' and banks' financial circumstances. So I'm going to start with Raymond. With these shocks becoming a lot more prevalent, how should model developers and MRMG teams better guard against or prepare for the impact of these shocks?
Thanks for having me, Mark. So there was one type of shock that was omitted, and that was conflict, which is very pertinent at this time when we have rockets being exchanged between Israel and Palestine. But that's a little bit off topic. As regards mitigation, so I've taken this and I treat it in three parts. So one is saying keeping it simple, another is having backup plans, and another is have a setup so that you can adjust quickly to changing circumstances. On the simplicity front, I think it's also a backup aspect, and that is to have a set of policy rules, at least for banks or instances where you have extremely high materiality and consequences that can result from shocks. We had an instance several years back where we had changed policy rules because we thought models could do everything. And then the crisis of 2007 and 2008 hit, and we realized that those rules were there for a reason. They had been developed over decades, possibly, and we had checked them out in favor of models. Be very careful. That also applies to the choice of models and the modeling types. There's much discussion. A lot of banks will focus on things like logistic regression, and they want to have the transparency, which is actually wise, but there's this thing about machine learning models and artificial intelligence, and a lot of people using it, especially for the low value, high volume lending. If you are going to go that route for a less transparent approach, have some simple approach as a backup. And even and in all cases, try to make things as simple as possible. It's going to be the Bernard de Chartres quotation about just keeping things simple. When Bernard de Chartres, Albert Einstein, whomever you wish to attribute the quotation to. Ultimately, I think there are the three aspects. You want to have the robustness, and the robustness will come from the simplicity, but you also want to have the precision, but the precision will come from the complexity. And the other aspect is reactivity. So does the approach that you use react to the changing circumstances, but not just react, does it react correctly? And another aspect is interactions. The more complex approaches, they tend to be better at addressing interactions in your development data, more so than the simpler approaches. But all types of approaches will be subject to changing interactions when shock scenarios hit. So one just has to be careful of those. Unfortunately, there are currently no real easy ways to address the interactions. And finally, under simplicity, one needs to have some feel for the data, have as many possible data sources as possible at your beck and call up front, and not only at the time when you're developing the models, but also to fall back upon sort of come time when some other shock hits. So you may have other sources that become available in the meantime. Under the agility, I think the first thing is being able to react to your customer base. This is falling outside of the modeling space. So there's so much effort when COVID-19 hit was just saying, okay, we have people that are suffering. If we do not try to help them, we are going to suffer at the end of the day. We cannot, it's not business as usual. It's very much business unusual. So you had the forbearance, you had the communications aspect, trying to say, do you need help? How can we help you? And within that is the drill down aspect, being able to go into the various areas of the business and say, are the effects different from one area to the next? Can we treat this as a homogeneous whole or not? Typically, your portfolio is going to be quite heterogeneous. In this area too, you're going to have, you then start realizing, well, hang on, sort of the models that I've been using, they are not quite working as what we expected. You're going to have ways of overriding them. What do you do? Changing the cutoffs, reverting to judgment. There is going to be a governance process there. Do you have that streamlined to be able to sort of make the necessary decisions quickly? And at the same time, but when I say make the changes, that goes beyond the governance to also being able to implement it into the system so that the decisions can be communicated enterprise-wide. That was one of the greatest advantages of credit scoring when it came up. You no longer had to send out a memo to every branch across the United States out of St. Louis. You could just change a number and the change was effective.
So these frameworks that you're talking about are very helpful to the first and second line teams, but I wanted you to kind of deep dive into the models themselves. What can be done to ensure that these models are continuing to provide answers to the business through these kind of shock periods, and what should these teams be doing to prepare to ensure that these models are performing and functioning properly?
Well, if you're saying to prepare to make sure that the models are functioning properly, that's a lot of what went into the simplicity aspect. But then you have the situation where, okay, this is the business unusual, and you have to start looking at alternatives. So it's that aspect, the alternative models. The easiest would be to have challenges. If you're using a complex approach, have a simple approach available to you in need. Challenger models being, it could be a borrowed model. It could be having a model that used a longer outcome window, going from a more advanced machine learning technique to a simpler and transparent regression model. In the area of fraud, typically fraud will be neural networks or something quite complex, but developers will often have the regression models simply to understand what the neural network model is doing. So the on this, you've also then got the calibration. How are you, if you have a model, now before you get on to these other challenges, you want to have them in the background, but even if you do go to those other models, you might be saying, okay, we have an existing base. Let's try to sort of get better use out of what we have available to us now. It could be as simple as changing the cutoff in terms of business. And those changes in cutoffs may be distinct to certain segments. At this moment in time, you've got travel and tourism being hit hard, but other areas could be performing well. You might wish to adjust one area, the travel and tourism, be more conservative there than in the other areas. Now, if you want to get into the models, then it could be just a simple change of the cutoff within the model. Just move the whole thing up or down. Change of constant, not cutoff, but constant. So you take and you add 5 points and sort of all scores move up or down and you don't have to change your cutoff. But that at least will, could possibly, and it doesn't matter what type of model you're using, if you have a probability, you could take the same approach and adjust all of the outcomes similarly. But you also have the instance of a model deterioration. It's not just the constant that changes, but also the slope. So then you have to get in and apply that. It becomes more and more complex until at some point in time, you either have to look at modifying individual factors within the scorecard, perhaps with small adjustments, perhaps with large adjustments, or alternatively just say, we have to sort of go back to brass tacks and redevelop the thing from scratch. Unfortunately, it can take a long time before the necessary data is available. We are working in a period now where we know that the future is not going to be like the past. Pre-COVID is not necessarily reflective as post-COVID, and we are not out of the mid-COVID period. And we don't know when that's going to, we don't know when that end is coming. So not when you have certain countries in South Asia hitting 400,000 cases per day. We just hope that where we are here, that we're not going to have similar. We've got a smaller population and the thing is still muted, but who knows what's going to happen in the future.
Time will tell what will happen as a result of this pandemic. It's still ongoing, and I believe it's probably will continue on for the next at least year or so, if not more. So with my remaining question, I'm going to address this to Pravin. So now that we've kind of got a better understanding about kind of what can be done at the model level, as well as some basic frameworks, what about the ecosystem around the model? So I'm thinking in particular about the data and infrastructure. What can be done to make it more robust? And what are some other processes that teams can perform to better prepare for a shock period?
Perfect. Thanks, Mark. That's actually quite a good question. So I thought a good place to start when answering that question is something that Raymond actually raised last week in our previous discussion, which is the best place to start in a crisis is to know that a crisis is coming. And so if we start at the beginning, which is a point Raymond made, are we listening is the first part. And from a data and infrastructure perspective, the question then is, what can we do internally with the data we have to create early warning indicators of a pending shock? Remember, we can't do a lot about shocks. What we can do is try and avoid those shocks becoming crises. So if we start with the early warning indicators that trigger a pending shock, what are the obvious things that we should want to do in advance? One of them, I would say, the first one is to create population stability measures. If you start seeing a high change or a low change in specific measures, the volume of business coming in, a sudden change in channel, a sudden change in spend patterns, a sudden change in risk profiles, these should automatically trigger a warning that something fundamental is changing. And then the question is, what do you do about it? But I would say the first early warning indicator you want to have is a population stability measure. For those banks that are full service banks, and if you've got transaction accounts and credit card facilities that your customers are using, changes in spend patterns are wonderful early warning indicators. You can see changes in regional spend by tracking the location of the POS devices, point of sale devices. You can see changes in lifestyle among different customer segments. Are you shopping more at luxury brands? The economy is improving. Or you're shopping more at, let's call it utility brands, which suggests that the customer is anticipating some distress. So being able to identify changes in spend patterns is a wonderful early warning indicator. The nice thing is it's a data set that's rich enough that allows you to micro-segment your portfolio with data you already have. To Raymond's point, are you listening? And then the last one is changes in portfolio performance. If you suddenly start seeing upticks or volatility in your traditional seasonally adjusted experience, then again, the question's got to say, well, what's happening here? So I would say start by just creating those early warning indicators. Get your population stability measures, get your spend patterns, get your portfolio performance measures into production, and have the early warning indicators when something's changing. So now you know something's coming. What do you do about it? And one of the first things they teach you in business school is that there's two important rules to success. The first one is to do the right thing. The second one is to do it properly. And because every crisis, and Raymond went into the different types of causes of a crisis, because each crisis tends to be unique. Each period of stress tends to be unique. It tends to have a different severity, a different cause, a different length of time that it affects you. The question then becomes, what is the right thing to do? And a good place to start is to get the facts. And the facts are changing daily, as we see with COVID. But the question is, can we get the facts such as they are today as quickly as possible? And so the question is, what information infrastructure do we want to build that gives us the ability to access that information faster? And I would say there's three specific things to focus on. The first one, I would say, Marc, is the single view of customer. Do we have an aggregated view of our customer? Traditionally, banks have acquired many product systems, each product system optimized for that product. And the data exists. We have it in its product silos. But do we have an aggregated view of Pravin, Marc, and Raymond so that we know what their circumstances are? Can we see the changes in their payment behavior, in their utilization of their credit facilities? So the first thing I would say to aggregate is the single view of customer. Create that. Don't forget that you might have to deduplicate customers, because on certain systems, you might capture a person's initials in the middle of their name. In other systems, you might spell their name incorrectly. Sometimes you might open it with a national social security number. Other times you might use their passport number. And so you need to also deduplicate these customer records to be able to create a reliable single view of customer. So that's the first one I would say, get your single view of customer sorted. The second one I would say is start focusing on trend analysis. So building on the point about listening, start focusing on trend analysis. The problem with most banks, and we all complain about data, but the problem is not that we don't have enough data. The problem is that we have too much. So in a crisis, in a period of stress, what do we listen to first? So if we start building strict trend analysis on our portfolios, the important thing that we often forget to build is the early warning indicators. And I characterize an early warning indicator as something that tells you that a particular trend is outside of the norm. So it's a question of saying we've got reams of business intelligence reports that we build. Can we create thresholds? What is the normal range of those measures? And can we create automatic warning lights that go off when we drift outside of those normal ranges, so that we have those early warning indicators that something is happening? The final point I'd like to talk about in terms of accessing information faster is risk data aggregation. For those of you who have not had a chance yet to read it, BCBS 239, brought to us by our friends at the Bank of International Settlements, the people who brought us the Basel Accord, is definitely worth a read. Fundamentally, what we need to do is to be able to join the data from the various silos that we have within our organizations, to be able to access it faster and to be able to drill down into it faster, something that Raymond mentioned earlier. So the principles of risk data aggregation basically say we need reliable information, we need to be able to aggregate it fast, we need to be able to interrogate it fast so that we can make it relevant to the specific topic and crisis and information period of stress that we're in at the moment. And we need to get it in front of the right people at the right time. That's very important. So risk data aggregation and dissemination is actually very critical. So those are kind of, let's call it back office things we want. The next thing we want to focus on is modeling faster. So great, we've got the information, but now what do we want to do with it? And to Raymond's points, you've built a model. How do you create cadence now in terms of extracting value from that model faster? And how do you drill down both at a model level as well as a data level? So if you want to model faster, how do we do it? The first one is we want to be able to do portfolio micro-segmentation. We have to. And the reason for that is because different periods of stress give rise to different causalities and therefore different investigations. If I give you a simple example, there was a particular bank I was working with that was exposed to a strike to the mining sector. And that particular mining sector went into a prolonged period of strike action. And because that strike action was geographically concentrated around the region for mines, they were very worried about the exposure to that part of the country. So the first thing they did was they basically looked at the addresses of all their customers, the businesses, the individuals, the corporates that were located in that geo-fenced area, created a flag to say you were within proximity of the prolonged strike in that sector, and then basically reran all their dashboards and all their credit models on everyone in that affected zone. So they didn't rebuild their models from scratch. They took the existing code, they reran it on a sliced and diced microsegment of the population, and then were able to say, is this within risk appetite or not? What management action do we need to take? And that for me is exactly what I mean by portfolio level microsegmentation. Can we take a view that says, these clients of ours in a COVID world are exposed to the travel and tourism industry. Let's create the flag quickly. Then let's rerun all our credit risk dashboards, our scorecards, our PDs, our LGDs, our collateral valuation models on everyone exposed to that segment. So can we quickly be able to run portfolio microsegmentation? The importance of that, and the one thing that banks are very good at, is building good models. We're also very good at governing our models. The one thing we're not good at is running those models fast. And that's something we need to focus on. We need to be able to to slice our base data quickly, put them into the existing models and rerun them very quickly. So we want the governance, but we want that with agility, with cadence. We don't want to sacrifice the agility and cadence. That's very important. The second thing then we want to do is we want to focus on our ability to update our dashboards. So we all have dashboards. Again, I mentioned too many of them in most organizations. But the question is, how do we update those dashboards quickly if we need to? A typical example, again, coming from COVID, a number of geographies and regulators passed regulations that said, if your customer is a good customer up to the point of lockdown, and that customer you believe is not under distress, barring the impact of COVID, then a payment holiday for that customer is not necessarily a sign of prolonged distress. And therefore, that customer should not be necessarily treated as if he's in default, which is wonderful. And it's great to see our regulators being proactive. But now when it comes internally to our processes, we create a dashboard, a portfolio risk dashboard, which suddenly says, Pravin has missed 2 installments. He's now 2 installments in arrears. Therefore, he is high risk. Therefore, reduce his credit limits. Therefore, hold a higher impairment and capital. Now, how do we quickly and feasibly and manageably change our dashboards and adjust them to say, yes, he may have missed 2 payments, but those 2 payments that he's missed were allowed and pre-agreed payments that he missed. And we count the payments that he missed before, but we don't count the payments that he missed now because it was allowed and pre-planned. And so our ability to update our point of view within our internal reporting is quite important and quite difficult actually, but it is quite important to focus on that. The last one is to be able to calibrate our models again. We spoke about building our models quickly, to be able to run them quickly, but you want to be able to say, yes, I can run a capital forecast, I can run an impairment forecast, but can I actually recalibrate the PD model? Can I recalibrate my credit scorecard, which feeds into it? So often we have the ability to run, let's call it the forecast models. But when it comes to calibrating the assumptions, we battle. And therefore, it's important that our data feed, as well as the calibration model itself, is fairly flexible in its architecture, because that's the only way you're going to recalibrate your assumptions fast. The last point around faster modeling is the ability to run lots of sensitivities. So runtime is important, and the ability to run lots of forecasts, which again comes into flexibility of architecture, but also speed. Because if you can run lots of scenarios, you can quickly get a view as to where they cluster. It is a view because nobody knows for sure, but the point is by being able to run lots of sensitivities fast, you can basically get a view and take a view as to what's going to happen. And then coming back to the last point, which we made earlier, is governance. Can we govern fast? Because now if we have a bunch of scenarios we've run quickly, but hopefully reliably, and we now want to take a management action, who has the mandate to take that management action? And do we have the ability to execute that management action? And that's important. So the final part around the models is, how do we take the model answer and get it in front of the right governance people? And having post-governance, how do we get it into channel quickly? Because ultimately, most of the conversations with our customers happen via channel. So do we have the execution capability to take the answer from those models, the new scenarios we've run, map them to a management action which has gone through our accelerated governance, and then fit it into channel so that we can actually communicate it to our customers, so that we can reduce the stress of our customers by creating certainty. And that, I think, is what we need to do to allow us to manage better in the next crisis from a data modeling infrastructure perspective.
Absolutely. Absolutely, Pravin. And just echoing some of the things that I've heard, being able to move faster with purpose. And I think that's very important because you start from the ground up looking at the data, right? Being able to listen. I really love kind of the words you're using there, because I think that's just exactly what we're trying to do, is separate the signal from the noise, identify what is actually changed, what we're going to try and do about it from a modeling perspective, from a governance perspective. So I think that's just fantastic.
If I were to summarize exactly to your last point, in my mind, it's building cadence and clarity of communication. Because we don't know what's going to happen next. We do know we need to react fast. If we can build cadence and clarity of communication, our chances of coming out better is much higher.
Absolutely. Excellent. So before I close this out, Raymond, did you have any final thoughts?
This follows on one of the points that Pravin made about customer data. One of the things, my impression, is that a lot of banks and others were very heavily reliant upon the credit bureau, at least in the United States, as though that was the only source of information, when they actually had a lot of other transactional information at their fingertips, which was just not being utilized, especially for a bank that has transaction account data and perhaps credit card data. Those are extremely valuable sources of information. In Europe, it's being extended to open banking, where that data is now being aggregated. It's like a credit bureau, but for transaction data. And ultimately, that will probably dominate most countries. We're only just seeing the starting stages of that process where we are in South Africa. I have not really heard much about it in the United States, but I would recommend it. People tend to be or institutions generally, tend to be very closed about sharing such data. But at least in the credit space, it provides a lot of value that extends beyond just you. It extends to the broader economy.
Absolutely. Absolutely. Well, Raymond and Pravin, thank you guys so much for joining us again on this episode. And to our viewers out there, please join us next time on another edition of the MRMIA broadcast and this continuing credit risk series.
Thank you, Mark. Thank you, everyone.
Thank you. And good night, or good morning, or good afternoon, wherever you are.
All right.